Good morning, traders and investors. Roger Scott here, Senior Strategist for Wealth Press. Today's Thursday, it's April 20th. Don't ask me where this month is going, and don't ask me where this year is going. I was just talking to Tom Busby the other day, and we were saying how we remember New Year's Eve, and we're already past the first quarter. It's about 7:14. I have a live VIP room today, so for those of you who are in my VIP room, I will not be there today or tomorrow because we have a VIP live here in Ponte Vedra. I hope some of you guys signed up. It's going to be a great class. Remember, I'm still going to be doing my morning videos, so it'll give you a really good update of what's going on, where you should stay away from, and all the good stuff. Now, if you watch this on the YouTube channel, the Wealth Press YouTube channel, please subscribe to these videos, like our videos, comment, and I actually respond personally. While I'm doing this morning's video, I respond every morning to the other videos. So I'm always responding. Now, let's get into today's market action. Now, I hate to say I told you so, but boy, oh boy, I've been telling you this almost every day. The sustainability that the market is seeing in these beautiful, rosy, large cap earnings are just not sustainable. The market's down about 120 on the Nasdaq, which is beyond random, and about 147 on the Dow, which is also beyond random. I would say anything over 75, 85 on the Dow is beyond random. But with the volatility we've been seeing the last couple of years, it's now probably 125, 115. So 146 is definitely beyond random. You can also see here that the bond market is struggling at the lower end, and investors are very concerned that it's going to break down and fill this gap, which it almost had. It went all the way to 103.53, and the gap was at 102.95. So we still have about half a basis point before we fill this gap. And if the earnings continue to come out worse than expected, we may see interest rates go higher. Now remember, bonds and interest rates are inverse to each other. So if one goes down, the other one goes up. So if this goes down, interest rates go higher, which may happen if the economic conditions and the recovery that we thought we were seeing is not as good as it should be. Now, I'll get into the nitty-gritty of earnings when I do the upgrade, but today we've got Tesla. And just to show you, Tesla, I think they already reported, or it was yesterday, but look, they're down about 6.6%. They're all the way down here, not looking so good. Now, I think Tesla was yesterday, excuse me. We also had Abbott Labs, Alcoa, ASML, which didn't do so well, which is why the chips were down. Discover Financial, Equifax, IBM, all these stocks reported earnings. And today, oh boy, you've got American Express, Alaskan Airlines, AT&T, CSX, which is a railroad company here in Jacksonville, D.H. Horton, one of the biggest home builders. You got FITB, you got Genuine Car Parts. It's easier for me to just say the name than the ticker symbol. Nokia, Nucor Mining, Philip Morris, Rite Aid, Seagate, Taiwan Semiconductor, that's a big one right there. Xerox, a lot of companies. And then tomorrow is a wind down day, and then we start again. So far, the number's down about 4.8% from a year ago. And don't hold your breath. We're still just getting started. I'll do a full update tomorrow after the week is done. I want to let this market continue a little bit. Now, I hate to say I told you so, but remember when we were up here? You guys remember this? And I said, I think the market's going to cool off. It's a little too much too fast. We're still in this range. It was just a few days ago. It wasn't that long ago. And I also showed you how sectors, a lot of these sectors like energy and healthcare and utilities, which is still up there, were making all-time 20-day highs. And I said that's not going to sustain itself. Now I want to show you how it looks now. So you could see the difference between how it looked a week ago and how it looks right now. So we were up here, 99th percentile. We're now at 88th percentile. It's definitely coming off. That's energy. Another one was information technology. Remember, this was at 90-something place. Let me show you. It wasn't that long ago. It was about 3 weeks ago. Now we're down here. I'm not done yet. Let's look at healthcare. You got to watch these 20-day momentum levels. Look at that. We went to 91, and now we're at 80. And I told you that this thing was going to continue moving lower, and it just can't sustain itself at those levels. That's one of the reasons why I believe that this market was going to cool off. Now, it doesn't mean, let me just go back to the chart of the SPY. It doesn't necessarily mean that we're going to crash and burn and the market's going to cool off. We can come off here and then come back up. The trend is still pretty strong, but I think the odds are we're going to see more of this. And then possibly more of a cool-off. Now, I'll tell you more reasons for that. If you look at the sectors, now, if you look at it on a 6-month, 3-month, and 1-month basis, you still have technology, communication services leading. But look at it on a 1-month basis. Energy, material, healthcare. Communication services is not the top one anymore. Technology's already in the lower second half, and so is consumer discretionary. Do you remember I told you that technology and consumer discretionary are going to come next to each other, and communication services is going to join them? Remember, 1 month transfers into 3 month and then into 6 months. So I'm already seeing it right now. And by the way, this is a lot more realistic in what I'm seeing right now in the market. Energy, healthcare, materials, financial, consumer staples, communication services, those large cap tech stocks, technology, consumer discretionary. I got to be really careful. So keep your eye on this order of things. Now, let's talk about the nitty gritty and what happened yesterday in the market and what we can take away from it. And then I'll give you my top ETF and top option pick. Now, 3 major U.S. benchmark indices finished the regular session mixed as market participants digested a mixed bag of corporate earnings from big names. Wednesday's trading, blue chips underperformed, weighted down by weakness in Walt Disney, United Health, and energy stocks were one of the biggest drags on the market as crude oil slumped over 1%. Chip stocks didn't do well, with ASML reporting a 46% drop in first quarter net bookings. And by the way, I've been talking about this in the VIP room, that bookings for chips are not nearly as where they should be. So if any of this is new to you, you haven't been watching my morning videos and you haven't been paying attention to my VIP room. Federal Reserve released its beige book on Wednesday, noting the U.S. economy stalled in recent weeks. What a surprise. Who could have seen that coming? Oh my, it must have been a shock to Squirrely Powell. I mean, really? Did you guys see the core CPI slowing down? It's going in the other direction. It was 4.6. It was worse than the previous level. Overall activity was little changed in recent weeks, with expectations of future growth unchanged, which means we're not getting out of this nearly as quick as you thought we were. Williams said Wednesday that inflation is still high and U.S. central bank policymakers will use monetary policy tools to restore price stability. Yeah, I love how he speaks fancy. We will use monetary policy tools. Basically what he's saying is we're going to keep rates high. We're not going to do jack. U.S. futures are now pricing in an 80% of a 0.25 rate hike. This went from 66 to 45, 66, 45, and now it's at 80%. And it's happening on May 3rd, by the way. On the earnings front, Tesla plunged over 7%. IBM rose 2%. So things are mixed. So the offset on one stock could offset the other stock if one goes lower in earnings and one goes down. That's what's so good when you have 50 or 60 companies reporting. Analysts expect corporate earnings for S&P to fall 4.8%. Now, remember this number because I think this number is going to go close to 10% by the time we're done. It went actually from 5.2 to 4.8 with the big banks reporting, and everybody thought things were rosy and peachy. And I said, rainbows, fairies, and crickets are not anywhere near us. We're not going there. And again, I'm not a perma bear, but I mean, I'm just looking at the data. Existing home sales, which were at 4.58 million, they're coming out today. Figure is going to be at 4.5 million. Jobless claims, I want to see if the number picks up above 240,000. That's coming out at about 8:30. And today you've got Walker, Harker, Mestic, Bostic, Bowman, and Logan speaking. I can't wait to hear what these clowns have to say. Oh, yes, things are getting better, and we're going to. Let me tell you the truth, okay? I'm going to be honest with you. The reason the bond market is not cooperating with the analysis right now, and I'll tell you why. Because the bond market believes we are in a mild recession. And if we are, the Fed's going to have no choice but not to raise rates. And they're going to try to spin it and say they're doing it because what they're doing is working, because their monetary tools are working. Don't believe that for a second. In Europe is down 0.53 this morning as investors continue to digest more corporate earnings while awaiting the release of minutes from the ECB's latest policy meeting. That's happening. And China's Shanghai today closed slightly lower as data released earlier this week pointed to an uneven recovery, which kind of makes sense. They've been through a lot. I mean, they just finished their COVID like 3 months ago. But I'm not hearing anything about COVID, which is thankful. Japan's Nikkei recovered from early losses, closed slightly higher, helped by chips and retail stocks. Also weakening yen boosted export-oriented stocks. And then today we've got Las Vegas Sands, we got Zion Bancorp, Las Vegas looks to be rocking and rolling with China back in action. So keep your eye out on the gambling stocks. They may be making new highs. Alcoa fell 3% pre-market. And we've got a slew of earnings, as I mentioned today, a lot of earnings. KeyBank, Nokia, Nucor, Philip Morris, Pool, Rite Aid, Seagate, Taiwan Semiconductor. Keep your eye on Taiwan Semiconductor. That's going to be really big for the chip sector. And I think you're going to get a lot of uncertainty and a lot of choppiness as a result. Now, today's Thursday, and I always on Thursday give you my top ETF and option pick. So let me tell you what I'm liking right now. I like the basic materials and I like the healthcare. My suggestion would be, let me just look at the chart here. My suggestion right now, would be to do the basic material sector. I like basic material, and it's fairly stable and it's not as volatile as the other sectors. And we may see more upside because we're not really testing this level just yet. And I like the stability that we're seeing right here. Now, I'm going to give you an option price. And we're going to go to 57 days. It should give you more than enough time. You can also go to September if you really are a long-term trader, but you could probably go to June, January, February, March, April, May, June. Yeah, June or September. It's your call, but I would probably go to June and then roll it. And there's no liquidity here right now because markets are still closed. But once it opens, that spread will tighten, and you can probably get the 82, 83. Again, this is the 148 days. This is like half a year from now expiring. If you want to go closer, there's a lot more liquidity here, which is what I recommend. You go with the 82, you could probably get it for about 250, 220, somewhere in that ballpark. Or the 83, so this will be about 250, this will be about $2. I wouldn't go further than that. Or what I would probably do is put half of my exposure into energies and half of my exposure into basic materials. That would probably be a safe bet. I wouldn't be in tech right now, just too much vulnerability, just way too much vulnerability and uncertainty. And you can go here with tech, 57 days, hold this for about 3 weeks, 2 weeks, and then roll it into the next one if you're not going to get any love out of it. And there's plenty of open interest here. You can go with the 87. It's about 330. This one is about less than 3. So 87 or 88 strike price. Now, before I let you go, folks, AI stocks have been breaking out over the past week, and Lance Ippolito, he's got a surge volume flagged by a master indicator. He's holding a very special session today at 4 p.m. Eastern Time. That's right, 4 p.m. Eastern Time, nice and late to give everybody a chance to show up when they're not hustling and bustling on Thursday afternoon. And today is Thursday. This is live. Oh, man, I hate when people ask me if it's live or recorded. Well, you're going to watch the recorded version, but I'm live right now at 7:26 in the morning, and it's 4:20. Hey, 4:20. So he's holding a special trading session at 4 p.m. Eastern Time today to show you how the master indicator works. He'll also scan for opportunities and share a handful of tickers and trade ideas that he's watching right now. And as always, it doesn't cost you anything to attend. Click the link below, sign up for Lance's presentation. You don't want to miss out. If you're watching on the YouTube channel, there's a link in the Wealth Press YouTube channel. And while you're there, subscribe, like, and post comments. I will respond. Have a great day. I'm holding my VIP live. I will resume VIP on Monday, and I'll make sure to make these videos as impactful and as content-focused as possible till that day so you guys aren't led astray. Bye, guys. Have a great day. And if you have a question, you can always email me, support@marketgeeks.com, and I will respond. Have a great Thursday or Friday Eve, as somebody I know likes to call it. Bye.